Good afternoon and welcome to this week's edition of Halftime Talk. We're delighted to have back at our virtual table Mr. Joe McMonigle, who is, of course, the Secretary General of the International Energy Forum, now a veteran of Saudi Arabia and the Gulf. Welcome back, Joe.
Great to be with you again, Sean.
So, Joe, since we last had you on, obviously the world has changed in so many profound ways, but in one way, it hasn't changed that much. It's just become more profound, and that is the challenges of getting investment into the oil and gas industry and building that capacity that we need not only for today, but moving forward. I was quite taken by your recent report. I just welcome your headlines of what your findings were.
Yeah, well, thanks again for having us. And I think you're right. I mean, we one of the first things I did as Secretary General of the IEF was in 2020 to issue a report with Boston Consulting Group at the time on what we viewed as a crisis in investment in hydrocarbons, mainly because of the CapEx cuts caused by COVID. But of course, no one really paid attention to that report when it came out in December of 2020 because prices were, much lower than they are today.
The world was ending.
Yes, exactly. And we issued the latest report in December of 2021, of course, with prices much higher, and people are starting to pay attention to it. And essentially, what that investment report, both in 2020 and 2021, found that CapEx cuts in both years were about 25% each, and basically showed underinvestment of 25% compared to pre-COVID levels. Last week, as you referenced, we issued
pre-COVID levels were also already at a low base from where they had been.
Yes, yeah, exactly. Yeah, they had been a lot, much higher. So last week, as you referenced, we issued our mid-year assessment, which we really felt compelled to do because there were so many new factors that we hadn't even really considered in the previous reports that we think are contributing to really the dark storm clouds for underinvestment. And the obvious one is the Russia war, and not just the geopolitical premium, but the actual supply constraints that are involved with that. Inflation, of course, is a big one, and if you're a company trying to make a final investment decision on something, now you have to take inflation into account and maybe have to revisit previous FIDs. Supply chain issues are certainly involved in the energy sector, and involved in that, of course, are labor shortages as well. Rising borrowing costs, even before the current year, the capital costs for hydrocarbons are much higher than other types of projects, and I think that's just increasing. And then also we have policy uncertainty, which seems to be also a big driver. And so what we concluded, just looking at the mid-year, as we're starting to work now on gathering all the data to compile in the report that we'll issue at the end of the year, it's looking like 2022 will be the third year in a row of underinvestment compared to pre-pandemic levels. And we think investment needs to rise to about $525 billion every year until 2030 just to meet demand. And perhaps the 3 years in a row of underinvestment may force a change even to that number. I'm aware that others are calling for even a much higher number than we concluded in our report, but at least that's essentially what we said in this mid-year assessment.
Which, I mean, it's an interesting time to be releasing the report, and obviously you gave us some of the background there, where in previous years, obviously there was a lot of noise on the sidelines, including the pandemic, as well as somewhat collapsing demand globally. But now on this year, the oil companies, the energy companies are making record profits. They've never made more money than I think in the first few quarters of this year. And yet we're not seeing that, you said it again, another year, 22 of underinvestment. I mean, where is the responsibility here? I mean, where is the chicken and the egg of this equation? Is it the industry isn't doing its part, so to speak, which is kind of a narrative out of Washington, or industry doesn't see the economic opportunity? Where do you see the problem and then the solution, perhaps?
Well, I think a lot from the public company side of the ledger involves investor pressures and this word capital discipline that we hear a lot from producers. We had a meeting, a Global Energy Risk Forum in Madrid about 10 days ago, and one of the company representatives there remarked that capital discipline is different at $120 a barrel of oil versus $50 a barrel of oil. So you have that part of it. As you said, the policymakers are talking to producers and urging producers to produce more, not just companies, but also NOC actors and countries. But I also think there needs to be a discussion with investors, because it's not just return on investment type of pressures, which is definitely an issue. The sector was underperforming for many years as compared to tech and healthcare sectors, and investors went where they could get a better return, although that I think is changing now. But it's also involves, ESG pressures, transition pressures. And so I think there has to be, if we want to see a change here, we need to bring in the investor community into the conversation.
How does one do that ultimately? I mean, this is a time also where we've got a robust, as you referenced in your opening comments, rise on interest rates. The borrowing of money is definitely going to be going higher, and who knows how high. I mean, if you listen to the Fed, they'll do whatever it takes to get inflation down to 2%. That could see rates, the price of money, rise, who knows, 3, 4, 5%.
Yeah, I mean, I think the investor community would, they want to follow, the best returns, and I think the at least currently the energy market, I think, has some great opportunities even in this climate. But I think it's still there's tremendous pressure. I'm not talking about the investors, searching for better returns, because they're already in the space, but really this ESG sustainable investing pressures. I think there's nothing standard about ESG investing.
There's certainly been a pushback against ESG recently. I mean, just in the last few weeks, we've seen, I think, an early a day doesn't go by in the Financial Times without a kind of a ESG bashing article that it's kind of overreached, and it has, as a result, all of these different consequences.
Well, there's certainly been an outflow of funds from the ESG sector really since the energy crisis. And I think just like, the G7 leaders are grappling with the energy crisis now in Germany, I think the investors are starting to realize that energy security is still something that we have to keep in mind. And the simple fact is that, during COVID, we saw this, record drop in, demand of about 10 million barrels a day, 8 to 10 million, depending on your estimate. But another way to look at that is that the world still used 90 million barrels a day when we were in a global economic lockdown. And I think it just goes to show you how prevalent, energy and hydrocarbons in particular is to the global economy. And there really is no current replacement for hydrocarbons in the energy transition. There are technologies that we want to pursue, and rightly so, but they're not mature or in the commercialization stage. I mean,
We're seeing that now, aren't we? How resilient oil demand is in the face of 100+ barrel demand is not really being destroyed too quickly. But Joe, I wanted just to pick up on that point you mentioned there, energy security versus energy transition. You, of course, at the IEF have the privilege of having the membership of all of the sides of the equation, both consumers and producers of energy. It's unique in that way, the IEF, whereas the IEA typically is a consumer organization, OPEC is a producer organization, but the IEF has all of the people in the room. I wanted to get your sense of where we are now, 6 months after COP, when it seemed energy transition had blown energy security off the table. And now there's obviously, in a very short period of time on the back of Ukraine, a move the other direction. And it looks to me, and particularly in the Europe's case, they're still trying to have their cake and eat it. They want their energy transition, but they want their energy security. I'm wondering, where do you think those two can balance out at this time? And will countries have to give up a bit of energy transition to get energy security over the midterm?
Well, I was at the COP meeting in Scotland, and of course, it was held against the backdrop of rising prices, particularly in natural gas and in Europe in particular. But also oil prices were already creeping up, and really, Europe was and Asia were in the beginning stages, if not the middle stages, of an energy crisis. So I think what I found at that COP meeting was a much more pragmatic, realistic view of this. As you say, this balance between energy security and energy transition. And I think I like to joke that energy security was previously in the backseat of the car. Now it's in the front seat. I'm not sure it's driving the car yet, but it's definitely back in focus. And the answer is we have to do both. We have to aggressively pursue the energy transition, while at the same time, investing in hydrocarbons until we have alternatives to meet the world's energy demand, and also to
just to bring that down to sort of ground level, Joe, and I'd welcome your thoughts. Like, for example, on LNG, we're seeing the Europeans now and their need to seek alternative sources of fuel. They're turning to places like Qatar and elsewhere for new LNG supply. And they're saying, well, actually, we only want it for 5 years, maybe 10. And of course, the producers are saying, no, we want security of demand. So we need a 20-year deal. Those are the kind of granular levels of where energy security versus energy transition, that the horizons need to maybe move out a little bit on energy transition. At least that would be the view of the producers, in order to have the certainty for investment. We've done some interviews in Central Asia, Central Caspian, Central Asia area, Azerbaijan and so forth. Same thing there. Hey, we're ready. Give us some security of demand.
Yeah, I mean, I agree with you. Europe is kind of the gold standard, I think, for the energy transition, and yet we see how they are now facing an urgent energy crisis. And so certainly energy security is back in focus there, and I think that's a good thing. I mean, look, I don't think the 2050 targets are not diminished at all. I mean, I think the world is very committed to that timeline. I don't think certainly we have to be careful not to call it the energy transition. It's really energy transitions, and there's really not one roadmap. There's many roadmaps, and so different countries with different priorities and circumstances are going to select the best roadmap for them in order to meet the goal that they set. So I think that's sort of how we look at it. That's certainly how member countries in the IF, and as you noted, we've got producers and consumers, but I like to say also we have developing and developed countries in our organization, and that is increasingly, a big play as well.
Joe, if we look at we've talked obviously the underinvestment in the hydrocarbon oil and gas space, where that underinvestment is particularly urgent, and you might say everywhere, but we see this year in this moment of great stress that there's still a lot of crude oil around, and that it seems the real stress is on the refining side, on the infrastructure of the product side, and the crack spreads are way above any sort of normal curve. I'm wondering, from your perspective and the research you guys have done, where is the sort of urgent, or where is the need for this investment, or where has the greatest underinvestment been?
Well, firstly, I mean, I think we have to recognize that post-COVID demand has recovered faster than supply, and that's even with a soft recovery in China. And I'm also particularly worried about the fall if as forecast, China demand comes roaring back after lockdowns are hopefully behind us. That's going to create new pressures on an already tight market. So, I think we want to be careful here. I'm not, according to the latest Jody data, demand is already surpassed pre-COVID levels, although there was a little dip in the April data. But supply is not yet back to pre-COVID levels. And I think, half of that supply gap is from U.S. production, which is not back to pre-COVID highs yet. And, this is something that, from an oil and gas perspective, this is not something OPEC can solve on its own. I think that's important to recognize. I think you're totally right on the downstream issue that you raised. We're currently working on a report on the downstream sector. We think there is a deficit of refining capacity, and we want to add some data to that issue. Certainly, COVID, I think, has accelerated closures and transitions from traditional refined products to biofuel products and other conversions. And really what's causing this reduced refining capacity is really policies and the whole decarbonization push. I mean, you just had a big refiner in the US announce maybe a month ago that it was continuing with its closure announcement or plans because it was part of its decarbonization strategy. And I think this is all being driven by policy, and it's curbing investment and supply ahead of demand will only result in higher prices and volatility. And so many times I think I think the market is sending us a signal that maybe we need to listen to markets and not models as much. And so the downstream is a huge problem. There's obviously some additional supply or capacity in China, but that's not really operating right now. So as a result, we are in a supply capacity, strategic capacity in downstream a decline.
And it's not a problem that can be solved very quickly, given the sort of the lead time one needs for expanding capacity. I just welcome your thoughts, Joe, on, you mentioned there, I mean, the President of the United States is coming to Saudi Arabia and the Middle East in the coming weeks, and one of the items supposedly on his agenda, I'm sure there's many things, but is to try and encourage more hydrocarbons to come out of this region. But you referenced, ironically, that the US is still under its pre-COVID production level by a sizable amount, maybe 1 million barrels or more. Why has that not come back? I mean, that's probably the surprise of all surprises, but prices at these levels and have been for a while, and the outlook is they will be for a while. Why US production, which typically reacts quite quickly to price opportunity, is not doing so on this occasion, and your outlook for that?
Yeah, exactly. I mean, the US is the world's largest oil producer and consumer. And during COVID, production fell by about 3 million barrels a day. And it's still about 1 million barrels below the pre-COVID highs. Yet demand is already back to pre-COVID levels in the US. So in many ways, the US is kind of a microcosm of the global energy security issue.
And the US is exporting over 3 million barrels a day.
Yes, yeah, exactly. And so I think, you know, a lot of this comes back to the investor topic that we discussed earlier. You know, I've talked to some of the heads of the service companies at recent conferences that I've been to, and they are seeing, I think, an uptick in activity in response to price levels from private companies, but public companies really have not changed their CapEx investment as a result of higher prices yet, and that's because of investor pressures. It's because of capital discipline issues that we discussed earlier. It's about you know, ESG investing and in other types of transition
And it's
pressures.
also a result of addicted to dividends, right? I mean, these publicly traded oil companies have all got themselves locked into a sort of an unbreakable bond with their shareholders. We want our dividends.
Of course, I mean, this is the total picture is something that's really holding back, I think, this investment. And you know, I guess I would say, you know, I'm not sure we're in a situation where we should be cheering on these activist investors getting on the boards of companies like ExxonMobil, and then, you know, urging them to sort of disinvest from hydrocarbon operations or production. I think this is counterproductive and actually is leading to the situation we face now, and that's higher prices and volatility.
Joe, if we might just wrap up with an immediate sense of time outlook. We're at the end of the first half of 2022. It's an amazingly fast 6 months, with a second half about to start. I'd welcome your outlook for the second half. There's clearly some big markers there. OPEC Plus is due to expire its current agreement. What's your sense of the outlook for that? We're in a space where 5-year averages of inventories were well below the inventory levels. So the second half of the year outlook from your perspective.
Yeah, I mean, I'm worried about the second half, and we put this in the mid-year assessment. I'm worried because of all the factors that we cited that are really weighing on more production and investment in new production. As I mentioned, you know, global demand is already back to pre-pandemic levels, and this is really with you know, soft demand in China and other parts of Asia, by the way. And I suspect in the second half of this year that that's going to increase, and thereby adding pressure to already tight markets. You know, there's a lot of discussion in the media today about this whole price cap, G7 price cap proposal. You know, that's dealing with this the impact of the shipping sanctions and restrictions that really, when implemented, that won't be implemented till the end of the year, but when implemented, that will, I think, do a lot to take Russian crude off the market, because it'll just become too expensive, and will impact, you know, trade flows even at discounted prices. And so that's designed, I think, as a workaround that, but that's another thing that's going to take additional supply off the market. And so I'm concerned for all these reasons. And I've been saying in recent speeches that I see higher prices and volatility for the foreseeable future until one of two things happens. And that's some kind of normalization of the Russia-Ukraine crisis and war. And by that, I mean the Russian supplies become available to the global market. And I don't know what the solution is on the that's someone else's portfolio on the geopolitics and diplomacy side, but we need Russian supplies to be normalized for the market, for higher prices and volatility to be reduced. Or
when you say higher prices, are you generally indicating above $100? Is that your reference for higher prices?
Yes, I mean, I think they could go much higher than even current levels in the second half of this year. Back in the spring or earlier this year, I suggested that we could see $150 a barrel, and I think that's still possible. But I'm just going back to my point. I think we're going to see higher prices and volatility until the Russia situation normalizes and those supplies are normalized to the global market, or there's a global recession and there's some a reduced demand as a result. And of course, nobody really wants that. But I think that's the situation we find ourselves in.
In terms of that normalizing stable outlook, do you think it's important, not important for OPEC Plus to continue to renew?
Well, I've said recently that there's a window of opportunity for them to make a change coming in the fall, and that's because the agreement expires in September, and also there's a new Secretary General starting, I think, in August. So either they have to renew the agreement or change the agreement in September, and I guess it's possible they could just extend it through the end of the year, but that again is going to be another window for them to make a change. So my guess is there will be a change in policy. We just have to wait and see because the current agreement is ending. So I suspect that there will be reflection on current market demands, and OPEC will take appropriate action. But as I said earlier, I don't think we could just rely on OPEC for stabilizing the market here. I mean, as I said, the half of the supply gap is coming from the U.S. production being lower than it is. There's lots of forecasts that there's going to be additional supply from the U.S. this year. But as I said earlier, I haven't really seen more than, even anecdotal evidence that investment in CapEx is returning in the U.S. So I'm concerned that supply number may not be what is being forecast.
Well, it certainly seems one of the challenges is that the less you put in the ground, the more is on your bottom line at the moment. So the incentive for the IOCs to go heavy into the Permian, at the moment at least, looks like a catch-22, because ultimately it could result in their revenue declining rather than increasing. So these are some of the counterintuitive challenges we'll see in the second half of the year. But Joe McMonigle, Secretary General of the IEF, thank you so much for being on Hard Time Talk this week.
Great to be with you.